Good morning. Welcome back to book club. We are reading chapter 7, Getting Gaps. Okay, so we previously went over decoding spikes, learning how to trade inside and outside of the day, trading range, and common special bars. All right, so we're moving on from that and we're gonna jump into gaps. Okay, so a gap is one of the most important special bar configurations. A gap is a major visible discontinuity between two price bars on a chart. Because every bar encompasses all the transactions made during a specific period, a gap marks the absence of any transactions at the prices covered by the gap. In this section, I give you pointers to identify gaps and how to use them. So pinpointing a gap. The gap is a void. No supply is offered at the price the gap encompasses. Check out the gap in figure 7-3. Prices had to shift upward in order for supply and demand to meet again, and for both buyers and sellers to be satisfied. On daily charts, you can often see an opening gap when the opening price today diverges dramatically from yesterday's high or low. Although you can also see gaps between bars on intraday charts. You can identify a gap at the open of the bar, but you can't measure a gap until the day trading is over. Then you measure it from yesterday's high to today's low for an upside gap, or from yesterday's low to today's high for a downside gap. The gap is between the bar's high and lows, not between the open and closes. Okay, if the security opens on a gap, but then gap is filled during the day, the gap doesn't show up on a daily chart. The same thing happens when a security gaps during the day on an hourly chart. The daily bar does not show it. So gaps are usually triggered by news like earnings or some other event, whether true or invented. That's why gaps are such a valuable pattern. You know instantly how the market is interpreting the news. The reason to read bars is to get an accurate assessment of whether news is big or merely ordinary noise. Some news is easy to interpret. News will start an uptrend if it's wildly favorable, or halt an uptrend dead in its tracks if it's wildly unfavorable. But much of the time, you don't know how to interpret news, and everyone is overloaded with too much news. So until you see how the market treats it in the form of the bar on the chart, traders often get the bit between their teeth on news, and this is especially clear with gaps. Consider how a gap develops. Say the blue widget stock closes on Monday at $15 per share. After the closing bell, it announces bad news. The bookkeeper embezzled $20 million and ran off to Rio. The market is unforgiving, and the next day blue widget opens gap down at $10. Most people deduce that the opening gap down implies further price drops, and they proceed to sell in droves. The total gap for the day may not be $5 though. During the course of the day, blue widget may trade as high as $12, making the net gap $3. If the price of blue widget normally trades in a $2 high-low range, $3 is still a significant number, 50% higher than normal. Gaps are significant when they're proportionately large compared to the trading range. Gaps occur with good news too. If blue widget announces a fabulous new discovery, the opening price on the following day may be a gap up, like the one in figure 7-3. You may deduce from this gap that some traders, including well-paid professional analysts, had a whole night to evaluate the news, and they bought the stock at the open, so you should try to buy it too. The gap implies buyers anticipate the stock rising throughout the day from the opening price, and you want to jump, if not leap, on the bandwagon. In equities, you can pretty much count on an opening gap on the day after an initial public offering. Using gaps to your advantage. Gaps are indeed a wonderful trading opportunity if you can differentiate between a common gap and uncommon gaps. In the following sections, I describe the main types of gaps and how to use them. So, lacking opportunity, common gaps. A common gap is one that appears out of nowhere for no particular reason and should be considered noise. Common gaps can occur in trending and non-trending prices. If the price is trending, it fails to change the trend. If the price isn't trending, it fails to initiate a trend. Common gaps are generally insignificant. What causes a common gap? Usually it's a simple error, A trader heard or thought he heard a market moving bit of news and made an offer above or below the market, or the trader was trying to break a trend line or had some other hidden agenda. Common gaps often occur when liquidity is low, meaning only a few players are in the market. A security that normally has low volume tends to have more gaps than heavily traded securities. A low volume security is described as thinly traded, meaning few market participants. Don't try to interpret gaps in thinly traded securities. These gaps are usually just common gaps and mean nothing at all. At the same time, a heavily traded security can also have gaps as traders flail around trying to validate the new gap direction because it favors their existing position, or fight against the new gap direction because if the price keeps going, their existing position will suffer a loss. Another cause of gaps in heavily traded securities is the fist fight between bulls and bears changing their interpretation of a new event. This is fairly common in the foreign exchange and commodity markets. To judge an opening gap, consult volume. If volume is low or normal, traders aren't jumping on the bandwagon and it's probably a common gap. If volume is abnormally high, traders are jumping on the bandwagon and the gap will probably lead to a big rise or fall in the coming days. Kicking things off, breakaway gaps. A breakaway gap is an important event because it almost always marks the start of a new trend. Not only do you get the gap in a new trend, but you also get a major change in the appearance of the chart, such as widening of the normal high-low daily trading range, an increase in day-to-day volatility, and much higher volume. A breakaway gap is often confirmed as significant when the price breaks support or resistance, or a channel or band. All these changes occur because the breakaway gap draws in new traders. A breakaway gap is event-driven, usually on some news about the security itself. So to qualify as a breakaway gap, the gap has to, 1, be proportionately big to the usual trading range. If the security normally trades in a $3 range between the daily high and low, and the gap is $15 between the preceding day's high and the gap day open, you can instantly recognize that something big has happened. Number 2, occurs when a price is only slightly trending or moving sideways. Nothing much is going on in the chart, and then bam, fresh news creates new supply and demand conditions and ignites a trend. You interpret a breakaway gap depending on whether it's upward or downward according to supply and demand. Number 3, upside breakaway gap. Good news creates demand. New buyers want to own the security and are willing to pay an even higher price to get it. Volume is noticeably higher than usual. Number 4, downside breakaway gap. Traders can't wait to get rid of their holdings and accept ever lower prices to achieve that goal. Volume is usually, but not always, abnormally high. Continuing the push, runaway gaps. A runaway gap occurs after a security is already moving in a trended way and fresh news comes out that promotes the existing trend. See the second gap in figure 7-4. What's the difference between a breakaway gap and a runaway gap? A breakaway gap starts a trend. A runaway gap continues a trend. In both cases, buyers become exuberant and offer higher and higher prices. Sometimes fresh good news bursts forth. Sometimes traders make up fresh good news, and sometimes the buying frenzy is just feeding on itself in the absence of any news at all. Notice in figure 7-4. Okay, so notice in figure 7-4 that after making new highs following the runaway gap, the price fell a little. A falling price after a dramatic move up is called a pullback. The security stops making new higher highs and may make some lower lows, but it doesn't go as far as the low on the breakaway day. A pullback after a dramatic price move represents profit taking by the early birds and is very common. In fact, professionals count on the pullback to buy the dip. If they get really enthusiastic, re-entering professional traders often supply the energy for a runaway gap that follows a breakaway gap. Calling it quits, exhaustion gaps. Exhaustion gaps occur at the end of a trend, signaling that the party's over. Volume is usually low. What's exhausted is the news that propelled the security up in the first place and the energy of the early buyers. An exhaustion gap is usually followed by a reversal. Here's how it works. This example is an exhaustion gap at the end of an uptrend, but the mechanics are similar for a downtrend exhaustion gap as well. When you see a gap up in an existing uptrend, and volume is low on that day, you have to wonder why the gap appeared. Volume tells you that buyers aren't pounding on the seller's doors to get the security. Presumably, some greedy sellers are out there, along with one last fool who's willing to pay a gap worth more than the last trade. The buying frenzy is over, but the buyer doesn't realize it. He fails to see that there are a lot of offers and few bids. In short, everybody who wanted to buy has already done so, but somebody has to be the last buyer, and this particular one got taken to the cleaners in the form of the gap. When he turns around and tries to unload his recent purchase, he finds no buyers, at least no buyers at a profit to him, and he has to dump the security at a loss. You can distinguish an exhaustion gap from a runaway gap by looking at volume, which is usually low on an exhaustion gap. Anytime you see wild new highs or lows that aren't accompanied by wild new high volume, be suspicious of the staying power on that move. You can exit altogether or move up your stop loss order. Scoring big, island reversals. Sometimes an exhaustion gap is followed immediately by a breakaway gap going in the other direction. This occurrence is how an island reversal forms. An island reversal is a single isolated price bar with a gap up on one side and a gap down on the other. It looks like an island in a sea of price bars and is almost always an unusually long bar, a wide high, low range. Okay, so take a look at figure 7-5. You see a series of higher highs, including a minor gap up, but then the last buyer realizes that they're all alone on the top of the mountain. They start to sell in a panic and are willing to accept a much lower price. Now the price takes off in the opposite direction on a breakaway gap. Remember, a breakaway gap tends to have high volume. This figure shows a single bar sandwich between two gaps as defining the island reversal, but it's also possible to get 2 or 3 bars forming the island, as in the case of the key reversal bar. Some analysts insist an island reversal is a single bar, whereas others insist it can be or should be a set of bars. The important point is two gaps, not how many bars form the island. What is being defined is a change in sentiment so powerful that it signals a reversal. Watching volume can get a little tricky. The island reversal bar has a higher high, but is accompanied by lower volume. This combination is the warning. The next day, as the breakaway gap develops, it has unusually high volume. High volume in combination with the downward gap is an indication that early selling is strong. Later prices aren't going to go back and fill that gap. Now consider this case in reverse order. Everyone and his brother has been dumping the security, and it's been gapping downward as it trends downward. This time the frenzy is a selling frenzy. At some point, traders realize that the selling has gone on long enough and maybe the price is now too low, a bargain. Another trader agrees and buys it from him and offers it on the market at a gapping price and wins. Turn figure 7-5 upside down. You can see how an island reversal at the bottom looks. Tip: examine enough charts and you'll see a lot of gaps. Seldom, though, do you see an island reversal, but when you do see it, here's how to respond. An island reversal at the bottom, buy. An island reversal at the top, sell. Despite its rarity, chances are good that a large number of people will identify the markings of an island too and cause the expected reaction, the self-fulfilling prophecy aspect of technical analysis. Warning: although you can't know for a day or two after the second gap that you have an island reversal, many commentators speculate that an island is forming when they see the first gap. Close your ears when you hear the market chatter like this. Form your own judgment. Is an island reversal forming? Is one of the most asked questions the market technicians hear, and one that can't be answered on a technical basis until a day or two after the second gap. Filling the gap. You may hear that a gap must be filled. This emphasis on filling the gap is usually nonsense uttered by people who are trying to sound worldly and wise, but really don't know what type of gap they're dealing with. Filling the gap, like figure 7-6, means that the prices return to the level they occupied before the gap. If a security takes off on a breakaway gap, sometimes the price doesn't return to fill the gap for many months or even years, if ever. Stop and think about it. When the fundamentals of a security change dramatically, why would market participants sell it back down to the level it was before the big event? Conditions have changed permanently, and so has the price of the security. If a company has invented some new must-have product, the new higher stock prices may not be the right price, but the old prices, based on the old conditions, aren't right either. A runaway gap or common gap is another matter. Demand for the security is normal and not under the influence of news or changing conditions, so the gap may be filled by bargain hunters. Sometimes a gap gets filled because the chatter about filling the gap makes it a self-fulfilling prophecy. Tip: how do you know whether a gap will be filled? If it's a breakaway gap, it probably won't be filled, at least not in the near future. If it's a common or runaway gap, it might get filled or it might not. You need to look at other indicators such as momentum, chapter 13, or to confirm whether a price move is at risk of going back to fill a gap. Okay, cool. We'll stop right there. Next time, we're going to read about using the trading range as a tool, determining the meaning of a range change, looking at the average trading range, how to discover the average true range, and then we'll move on to chapter 8, redrawing the price bar and looking at Japanese candlesticks. Cool. Thanks for joining. See you next time.